I accidentally showed my address and I had to delete the video. Dang it. Anyways, I was trying to look for my final exam schedule here, and I think I found it. So, here we go. What is the date? Oh, really? The 20th? Wait a minute. What day is the 20th? Oh, Monday. Wait, so that must mean the 21st is a Tuesday. Oh, you've got to be kidding me. The last day of school is on a Wednesday, the 21st? Man. Our final exam for accounting information systems is on the 20th. Gotta be kidding me. Gotta be kidding me, dude. It's on Tuesday, which is like our normal class time, pretty much. And it's our normal classroom. In fact, all of our exams are in our normal classrooms, according to this. So, on the 15th, on Thursday, for no apparent reason. Now, thankfully, we might not have like actual class for the first part of the week. Although, let me check. Let me check the schedule for intermediate accounting. According to this schedule, dang it, man. Wait, we do have class the day before the exam. God, are you kidding me? I think we just have normal classes until Thursday. Oh. We have normal classes until Thursday. And on Thursday, we have 2 exams. That's great. That's just great. Now, I'm going to have barely any time to study for the exam. Unless I want to study in, like, the late evening every single day. Come on. Come on. I'm probably going to do... I'm going to just... If I really don't want to have to cram all of my studying in during the week, I'm going to have to do it all over the previous weekend. Why? Both of our exams for these classes are on the 15th. Thursday, the 15th. At least we won't have a class on Friday. Oh wait, right? That's true. Why would we have a class on Friday if we took the exam on Thursday? Who really cares? Like, that's not fun at all. 2 comprehensive finals. Is our final exam for accounting information systems going to be comprehensive as well? Finals are going to suck. Why? Just... I mean, at least we probably won't have any class on Monday. But, man, I guess I'll have all day Monday to study for accounting information systems. I mean, I don't know if I can really study for a final exam in one day. It's hard enough to study for a regular exam in one day, but a final? That's fine. I don't know. I'll have literally the entire weekend to study for that exam. However, for these 2 classes, it's going to be... Well, I'll have the whole week up to Thursday, but I'll have normal classes on Monday through Wednesday. I'm going to have normal classes on Monday through Wednesday, which is not going to be fun at all. That's going to be a rough week. That was funny. That's going to be the hardest week of the entire semester. So basically, the last 2 exams will be very easy because I'll have literally the entire weekend to study for them, and I don't even have to study for one of them, I don't think, because it's not even a comprehensive final, and it's like a open book. So that's funny, and that was fun. Now I have to read this chapter. Dang it! I don't feel like reading the introduction. Valuing financial assets, such as loans, derivatives, and other debt investments, as well as equity investments, is a challenge. The fundamental question is, should financial instruments be valued at amortized cost, fair value, or some other measure? As one writer noted, the opinion on fair value. Recently, the FASB issued a new standard in this area. This new standard lets companies report loans at amortized cost. This decision means that banks will continue to value loans. I don't care. I'm just going to skip to the actual content. That was one. In Chapter 7, we discussed two types of financial assets, cash and receivables, primarily short-term. In this chapter, we discuss two other financial assets, debt investments and stock investments. Companies have different motivations for investing in debt or equity securities issued by other companies. One motivation is to earn a high rate of return. For example, companies like Coca-Cola and PepsiCo can receive interest revenue from a debt investment or dividend revenue from an equity investment. In addition, they can realize capital gains on both types of securities. Another motivation for investing in equity securities is to secure certain operating or financing arrangements with another company. For example, Coca-Cola and PepsiCo are able to exercise some control over bottler companies based on their significant but not controlling equity investments. To provide useful information, companies account for investments based on the type of security, at debt or equity, and their intent with respect to the investment. As indicated in the illustration, we organize our study of investments by type of security. Within this section, we explain the... That's fine. There's debt and equity. Debt, management intent. No plan to... Okay, debt. If you have no plan to sell, you use amortized cost. If you have a plan to sell the debt, investment, then report at fair value. Equity, if you plan to sell the equity, you have fair value. Exercise some control. Management intent. The heck? Debt securities represent a creditor relationship with another entity. Debt securities include U.S. government securities, municipal securities, corporate bonds, convertible debt, and commercial paper. Trade accounts receivable and loans receivable are not debt securities because they do not meet the definition of a security. Companies group investments in debt securities into three separate categories for accounting and reporting purposes: held to maturity, trading, and available for sale. Held to maturity: debt securities that the company has the positive intent and ability to hold to maturity. Trading: debt securities bought and held primarily for sale in the near term to generate income on short-term price differences. Available for sale: debt securities not classified as held maturity or trading securities. A held to maturity debt security. Valuation, amortized cost. Held to maturity. Do not recognize unrealized gains or losses. Held to maturity. Interest when earned. Gains and losses from sale. Trading securities. Fair value. Recognized in net income. The unrealized gains and losses in trading securities are recognized in net income. Trading securities, interest when earned, gains and losses from sale. It's the same for all of them. Really? Available for sale, fair value, right? Unrealized gains and losses, recognized as other comprehensive income and as separate component of stockholders' equity. Weird. For unrealized holding gains or losses, for one type of held to maturity, it's not recognized. For one type trading securities, it's recognized as net income, and for another type available for sale, it's recognized as other comprehensive income. Oh, amortized cost is the acquisition cost adjusted for the amortization of discounts or premium if appropriate. Fair value is the price that would be received to sell an asset or paid to transfer a liability to in an orderly transaction between measurement. Held to maturity securities, amortized cost. Only debt securities can be classified as held to maturity. By definition, equity securities have no maturity date. A company like Starbucks should classify a debt security as held to maturity only if it has both the positive intent and the ability to hold those securities to maturity. It should not classify a debt security as held to maturity if it intends to hold the security for an indefinite period of time. Likewise, if Starbucks anticipates that a sale may be necessary due to changes in interest rates, foreign currency risk, liquidity needs, or other asset liability management reasons, it should not classify the security as held to maturity. Companies account for held to maturity securities at amortized cost. Companies account for them at amortized cost, not fair value. If management intends to hold certain investment securities to maturity and has no plans to sell them, fair value selling prices are not relevant for measuring and evaluating the cash flows associated with these securities. Finally, because companies do not adjust held to maturity securities to fair value, these securities do not increase the volatility of either reported earnings or reported capital as do trading securities and available for sale securities. To illustrate the accounting for held to maturity debt securities. Oh no, we need a financial calculator. Thankfully, I got one on my phone because I paid. That was fine. I paid like $3 or something to kind of install it into like one of my calculator apps. But anyways, I think that I should be able to do that on my phone, right? If I'm not able to, I can use Excel, but Excel is a little bit more tedious. Because you have to like type all the numbers. Well, not really, because all you have to do is type all the numbers in a certain order. Like you don't have to type all the numbers into the cells and then do the equation. You could just do the equation without typing all the numbers into cells. So Excel isn't so bad, and plus our test might end up being on Excel. So probably if we have this question where we have to calculate something with the financial calculator, then I can probably just use Excel to do it. I don't really need my phone calculator. But anyways, thinking, that's funny. To illustrate the accounting for held to maturity debt securities, assume that Robinson Company purchased $100,000 of 8% bonds of Evermaster Corporation on January 1st, 2019 at a discount, paying $92,278. The bonds mature on January 1st, 2024 and yield 10%. Interest. What the heck? Interest is payable each July 1st and January 1st. Records the investment as follows. Okay, we have periods 10. We have 10 periods because there. It says that there's biannual interest. Interest 5. What the? How is it? Oh, the reason it's 5, so 8% is not in the equation? Really? Okay, $4,000 is like 8% of. Oh, geez. Oh, geez. So we have 10 periods because it's 5 years, but 2 biannually. Interest is 5 because it says the yield is 10%, and it's payment. How does that make any sense? What? Payment is 4,000. Where'd you get 4,000? Is it like 10,000 divided by 8% or something? I mean, times 8%. $8,000 is 8% of 100,000, and divided by 2 because it's twice per year is 4,000. Man, that's awesome. That's awesome. So we need the present value. Screw you, dude. You already told us the present value. Why do you need the calculator solution? Are they gonna make us do a financial calculator thing? So here's the recording of buying the thingy. So basically, debt investments increased by 92,278 and cash decreased by 92,278. But you do not record interest yet because you have not accrued interest. I mean, you're not accruing an interest liability until after you've made the payment. Companies must amortize a premium or discount using the effective interest method unless some other method, such as the straight line method, yields a similar result. They apply the effective interest method to bond investments in a way similar to that for bonds payable. Oh, geez. Oh, geez. Amortization is not going to be fun. To compute interest revenue. Wait, no, it's interest revenue, not interest expense. If you buy a bond, that means you're going to make interest revenue. Not pay interest. That's if you get a loan. If you get a loan of $100,000, that means you pay interest. If you buy a bond, which means you're basically loaning $100,000. I mean, you're lending $100,000. That means you're going to get paid interest. That was funny. You're going to get paid 8% interest, but the yield is 10%. The yield is 10%. Payment, 8%. Yield, 10%. Oh my gosh. Why is it so confusing? I took a corporate finance class. It should not be hard. No, it is hard. And I don't like finance. I don't know why. I just don't like it. It's funny. I specifically chose accounting rather than finance. To compute interest revenue, companies compute the effective interest rate or yield at the time of investment and apply that rate to the beginning carrying amount book value for each interest period. The investment carrying amount is increased by the amortized discount or decreased by the amortized premium in each period. And I'm going to need to practice this quite a bit to actually get this down because oh my goodness, like what type. If we're doing problems, this would be really terrible to do on pen and paper. Excel is like almost required for this. Oh my gosh. First payment, you received $4,000. You received interest revenue. How do you calculate the interest revenue? Well, you do $100,000. What? No, I know how you got the 4,000. How did you get the interest revenue? Oh, so you take the current carrying amount, you multiply by 0.1, and you multiply it by 6 out of 12, and you get the interest revenue. The difference between interest revenue and cash received is going to be amortization. And D is going to be that plus the amortization. And then you continue with it all the way down the line. And you would just use Excel to repeat all the calculations. You wouldn't have to do every single calculation because that would take 5 years. You would think in this case our professor really would want us to try and do this with Excel instead of pen and paper. So you receive the payment on July 1st. Here's how you record. You record cash of $4,000. You record interest revenue of $46.14. And the difference is the debt investments. So basically, the $614 is added to the debt investments because on this you add it until it gets up to the future value of $100,000. So cash $4,000, debt investments $614, interest revenue is that it's on a calendar year basis. It accrues interest and amortizes the discount on the 31st. Oh boy. It accrues interest and amortizes the discount at December 31st. Oh, great. Interest receivable $4,000, debt investment $645, interest revenue $645. Oh my gosh. Here's how you report the investment. Current assets, interest receivable $4,000, long-term investments, debt investments, held to maturity $93,537 because this. Income statement, other revenues and gains, interest revenue. So you made that one and then you made that one. That was. Sometimes a company sells a held-to-maturity debt security so close to its maturity date that a change in the market interest rate would not significantly affect the security's fair value. Such a sale may be considered a sale at maturity or not call into question the company's original intent to hold the investment to maturity. Let's assume that they sell the investments on November 1st, 2023, which is when? A month before? At 99 3/4 plus accrued interest. The discount amortization from July 1st, 2023 to November 1st, 2023 is this, which is 4/6 of 952, because the original amount was 952, but it's only a certain amount. So they recorded it at 635, debt investments and interest revenue of 635. Yeah, but why don't you record? Okay. Selling price. It was not quite up to 10,000 yet, so that's funny. And selling price is this less book value of bonds on November 1st. This is the amortized cost, add the discount amortized for the period. The heck? Gain on the sale of bonds, $67. How did they receive that much cash? It's because of interest revenue, so that was fun. Interest revenue is worth that. Oh man, that's not gonna be fun. Credit. Interest accrued for 4 months for which the purchaser pays cash. Selling price of bonds plus accrued interest. because the selling price was actually this. But the debt investments. A credit to debt investments is the book value of the bonds on the date of the sale. The credit to gain on sale of investments represents the excess of the selling price over the book value of the bonds available for sale security. Available for sale. Debt security. Available for sale security. Companies like Amazon.com report available for sale debt securities at fair value. How is it not done yet? Available for sale debt securities at fair value. It records the unrealized gains and losses related to changes in the fair value. It records the unrealized gains and losses resulted to changes in the fair value of available for sale debt securities in an unrealized holding gain or loss account. Amazon reports these unrealized gains and losses in other comprehensive income. For the period. Wait. They skipped trading securities. Why did they go straight to this one? They put it in a certain order there, and now they're doing it in a different order. Reports these unrealized gains and losses in other comprehensive income is then added to subtracted from accumulated other comprehensive income, which is shown as a separate component of stockholders' equity until realized. Thus, companies report available for sale securities at fair value on the balance sheet, but do not report changes in fair value as part of net income until after selling the security. This approach reduces the volatility of net income. Example, single security. To illustrate the accounting for available for sale securities. Assume that Graph Corporation purchases $100,000 10% 5-year bonds on January 1st, 2019 with interest payable on July 1st and January 1st. The bonds sell for $108,101. Which results in a bond premium of $8,101 and an effective interest rate of 8%. The course of purchase of the bonds as follows: debt investments $108,101, cash $108,101, illustration discloses the effect of the premium amortization on the interest revenue. Graph records each period using the effective interest method. The carrying amount goes from 108,111 to 100,000. The bond premium amortization is going to be a certain amount of money. Cash receipt and the interest revenue is going to be less than the cash receipt because it keeps going down or something or whatever. Ooh, and then it goes down and down. Oh, that was funny. Oh. Isn't that fun to keep track of? The entry to record interest revenue on July 1st, you have cash and debt investments is going to be credited because it decreased. Interest revenue was 4324. And then at the end of the year, you have interest receivable, debt investments, and interest revenue. So to apply the fair value method to these debt investments, so interest revenue, assume that at year end the fair value is $105,000 and that the carrying amount of the investments is $106,732. Comparing this with this, there is an unrealized holding loss of $1,732. It reports this loss in its other comprehensive income. The entry to record the unrealized holding gain or loss is going to be unrealized holding gain or loss equity 1,732 fair value adjustment. What is fair value adjustment? Instead of crediting debt investments account, you use the valuation account. Ooh, fair value adjustment. The fair value adjustment is going to decrease the debt investments account. Ooh, use of a fair value adjustment enables the company to maintain a record of its amortized cost. Because the adjustment account has a credit balance in this case, graph subtracts it from the balance of the debt investments account to determine fair value. Graph reports this fair value amount on the balance sheet. At each reporting date, reports the bonds at the fair value with an adjustment to the unrealized holding or loss equity account. Portfolio securities. To illustrate the accounting for portfolio securities, how is my laundry not still done after an hour and a half? The illustrated accounting for a portfolio of securities assume that Webb Corporation has two debt securities classified as available for sale. This identifies the amortized cost, fair value, and the amount of the unrealized gain or loss. Do, 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 do. The fair value total. The previous fair value adjustment credit is gonna be computation of fair value adjustment. The fair value of Webb's available for sale portfolio totals $284,000. The gross unrealized gains are $10,063, and the gross unrealized losses are $19,600, resulting in a net unrealized loss of $9,537. That is, the fair value of available for sale securities is $9,537 lower than its amortized cost. Webb makes an adjusting entry to the valuation allowance to record the decrease in values and to record the loss as follows. Unrealized holding gain or loss equity $9,537. Fair value adjustment. Webb reports the unrealized holding loss of $9,537 as other comprehensive income and a reduction of stockholders' equity. Recall that companies exclude from net income any unrealized holding gains and losses related to available for sale securities. Sale of available for sale securities. If a company sells bonds and carried as investments in available for sale securities before the maturity date, it must make entries to remove from the debt investments account the amortized cost of bonds sold. To illustrate, assume that Webb Corporation sold the Watson bonds on July 1st, 2021 for $90,000, at which time it had an amortized cost of $94,214. Shows the computation of the realized loss. The amortized cost less the selling price equals the loss on the sale of bonds. The sale is going to be recorded as cash $90,000, loss on sale of investments $4,214, debt investments $94,214. The realized loss is reported in other expenses and losses section of the income statement, assuming no other purchases and sales of bonds in the year. On December 31st, 2021, there's information. Anacamp Corporation bonds. You did not sell that one. We have unrealized holding gain or loss. The previous fair value adjustment was $9,537. It should now be $5,000. So the adjustment should to push the account from 9,537 to 5,000. You basically add 4,537, so that was funny. Has an unrealized holding loss of 5,000. However, the fair value adjustment account already has a credit balance of 9,537. To reduce the adjustment account balance to 5,000, you debit the account for 4,537. Fair value adjustment 4,537. Unrealized holding gain or loss equity. Credit. That was funny. So now we will look at the balance sheet and the income statement. Ooh. The Anacamp bonds are long-term investments but are not intended to be held to maturity. Current assets. Interest receivable. They don't even chill it. Investments. Debt. Investments. Oh, that was funny. Debt investments available for sale, $195,000. That's recorded. Oh, stop. Yeah, but aren't they supposed to show the fair value account? What? I thought they're supposed to show the fair value thingy. I thought they were supposed to show that. Debt investments available for sale, $195,000. Stockholders' equity. Accumulated other comprehensive loss. Income statement, other revenues and gains, interest revenue, other expense losses, loss on the sale of investments. Some favor including the unrealized holding gain or loss in net income. Man, it's kind of ridiculous how we still have basically an entire month until school ends this semester. Like, it feels like we're so close to the end, and yet we're still a whole month away. Some favor including the unrealized holding gain or loss in net income, rather than showing it as other comprehensive income. However, some companies, particularly financial institutions, note that recognizing gains and losses on assets, but not liabilities, introduces substantial volatility in net income. They argue that hedges often exist between assets and liabilities so that gains and assets are offset by losses and liabilities and vice versa. In short, to recognize gains and losses only on the asset side is unfair and not representative of the economic activities of the company. This argument convinced the FASB. As a result, companies do not include in net income these unrealized gains and losses. However, even this approach solves only some of the problems because volatility of capital still exists. This is of concern to financial institutions. Because regulators restrict financial institutions' operations. Regulators restrict financial institutions' operations based on their level of capital. However, companies can still manage their net income by engaging in gains trading, i.e., selling the winners and holding the losers. Trading securities, fair value through net income. Companies hold trading securities with the intention of selling them in a short period of time. Trading in this context means frequent buying and selling. Companies thus use trading securities to generate profits from short-term differences in price. Companies generally hold these securities for less than 3 months, some for merely days or hours. Companies report trading securities at fair value with unrealized holding gains and losses reported as part of net income. Similar to how to maturity of available for sale investments, companies are required to amortize any discount or premium. A holding gain or loss is the net change in the fair value of a security from one period to another, exclusive of dividend or interest revenue recognized but not received. In short, the FASB says to adjust the trading securities to fair value at each reporting date. In addition, companies report the change in value as part of net income, not other comprehensive income. For example, assume that on December 31st, 2020, Western Publishing Corporation had determined
is trading securities portfolio to be shown in the illustration. Assume that 2020 is the first year that they held trading securities. At date of acquisition, Western Publishing recorded these trading securities at cost, including brokerage commissions and taxes in the account entitled Debt Investments. This is the first valuation of this recently purchased portfolio. The total cost was this: the gross unrealized gains are these, and the gross unrealized losses are this, resulting in a net unrealized gain of $3,750. The fair value of trading securities is $3,750 greater than its cost. At December 31st, they make an adjustment entry to the fair value adjustment account to record both the increase in value and the unrealized holding gain. Fair value adjustment 3750, unrealized holding gain or loss, income. Because the fair value adjustment account balance is a debit, they add it to the cost of the debt investments account to arrive at a fair value for the trading securities. Western Publishing reports this fair value amount on the balance sheet. As with other debt investments, when a trading investment is sold, the debt investments account is reduced by the amount of the amortized cost of the bonds. Any realized gain or loss is recorded in the other revenues and gains or the other expenses and losses section of the income statement. The unrealized holding gain or loss income account is reported in the income statement. Other revenues and gains or other expenses and losses. The fair value adjustment account is then adjusted at year-end for the unrealized gains or losses on the remaining securities in the trading investment portfolio when securities are actively traded. The FASB believes that the investments should be reported at fair value on the balance sheet. In addition, changes in fair value and unrealized gains and losses should be reported in income. Such reporting on trading securities provides more relevant information to existing and prospective stockholders. It took me 5 billion years to read that section. Not the best time to do this, but it doesn't. Let's see. Still a decent amount left. I was looking at my bank account, that was funny. So, not even remotely close. Basically, after almost 3 weeks, is only gone down. That was funny. That was funny. It took me 5 years to read that. So, let's see. So, that was funny. We have to read to page 24. We're already up to page 11. Investments in equity securities. Equity securities represent ownership interests such as common, preferred, or other capital stock. They also include rights to acquire or dispose of ownership interests at an agreed upon or determinable price, such as in warrants, rights, and call or put options. Companies do not treat convertible debt securities as equity securities, nor do they treat as equity securities redeemable preferred stock, which must be redeemed for common stock or cash. The cost of equity securities includes the purchase price of the security plus broker's commissions and other fees incidental to the purchase. The degree to which one corporation investor acquires an interest in the common stock of another corporation investee generally determines the accounting treatment for the investment subsequent to acquisition. The classification of such investments depends on the percentage of the investee voting stock that is held by the investor. Holdings of less than 20%. Fair value method. Investor has passive interest. Holdings between 20 and 50. Equity method, investor has significant influence, holdings of more than 50%, consolidated statements, investor has controlling interest, illustration lists these levels of interest or influence and the corresponding valuation and reporting method that companies must apply to the investment. Percentage, so we have 0 to 20, we have fair value method, we have 20 to 50 is significant equity method, and 50 to 100 is control consolidation. So the accounting and reporting for equity securities therefore depend on the level of influence and the type of security involved, as shown in the illustration. Holdings less than 20%, fair value valuation. Unrealized holding gains or losses recognized in net income. Other effects: dividends declared, gains and losses from sale. Holdings between 20 and 50, equity, not recognized unrealized holding gains or losses, proportionate share of investees' net income. Holdings more than 50%, consolidation, not recognized unrealized holding gains or losses. There's no other effects. Companies report equity holdings that have less than 20% at fair value and report unrealized gains and losses through net income. The only exception would be for practicality reasons for determining fair value. Holdings of less than 20%. When an investor has an interest of less than 20%, so it is presumed that the investor has little or no influence over the investee. In such cases, if market prices are available subsequent to acquisition, the company values and reports the investment using the fair value method. Because equity securities have no maturity date, companies cannot classify them as held to maturity. In some cases, can use a practicability exception when measuring equity securities that do not have a readily determinable fair value, often referred to as non-marketable equity securities. If the practicability exception is elected, companies record investments at cost, less impairment. Companies recognize dividends when received and generally recognize gains and losses when selling the securities. Upon acquisition, companies report equity securities at cost. To illustrate, assume that on November 3, 2020, Republic Corporation purchased common stock of 3 companies, each investment representing less than a 20% interest. We have all those 3. Record the investments as follows. Equity investments is this, cash this. On December 6th, receives a cash dividend of $4,200 on its investment. It records the cash dividend as follows. Cash is $4,200, dividend revenue is $4,200. All 3 of the investee companies reported net income for the year, but only Campbell's Soup declared and paid a dividend to Republic. But recall that when an investor owns less than 20% of the common stock of another corporation, it is presumed that the investor has relatively little influence on the investee. As a result, net income of the investee is not a proper basis Net income of the investee is not a proper basis for recognizing income from the investment by the investor. Why? Because the increased net assets resulting from profitable operations may be permanently retained for use in the investee's business. Therefore, the investor recognizes net income only when the investee declares cash dividends. At December 31st, 2020, Republic's equity security portfolio as the cost and fair value shown in the illustration. That was funny. I forgot to change the image, dang it.